23 gigawatts. That's how much electricity artificial intelligence will consume by the end of 2025. More than double Bitcoin's current 10 gigawatt appetite. And with that single statistic, the crypto industry just discovered it's fighting a war it cannot win. The energy competition between AI data centers and Bitcoin mining isn't just reshaping electricity markets. It's creating an existential crisis that could destroy Bitcoin mining profitability and crash the network security that keeps the entire cryptocurrency ecosystem alive. I've been analyzing energy markets and cryptocurrency mining economics for over 10 years. And what I discovered in grid operator reports, mining company earnings data, and electricity consumption forecasts reveals a systematic threat that few Bitcoin investors understand. We are not dealing with temporary mining difficulty adjustments or cyclical profitability pressures anymore. We're dealing with permanent displacement of Bitcoin mining by AI infrastructure that can afford to pay exponentially higher electricity costs. The Bitcoin energy death spiral isn't some theoretical scenario for distant consideration. It's happening right now in mining facilities across America. CleanSpark, one of the largest Bitcoin miners, just announced they're converting mining infrastructure to AI data centers because artificial intelligence pays better for the same electricity. When major mining companies abandon Bitcoin for AI, that's not market rotation. That's the beginning of systematic network security degradation. The mathematics are brutal and inescapable. Bitcoin mining currently consumes approximately 175 terawatt-hours annually, but artificial intelligence is projected to reach 200-300 terawatt-hours by 2026. More importantly, AI data centers can pay 3 to 5x higher electricity rates than Bitcoin miners because their revenue models don't depend on volatile cryptocurrency prices. When utilities choose between AI customers offering guaranteed long-term contracts and Bitcoin miners offering variable demand, the choice becomes economically obvious. Let me walk you through the 4-stage Bitcoin energy death spiral that explains how AI competition will systematically destroy mining profitability and potentially crash Bitcoin's network security, because understanding this pattern might determine whether you hold Bitcoin through this transition or recognize the fundamental threat before everyone else. Stage 1. Energy competition emergence. New technology creates higher electricity demand. Grid capacity becomes constrained in key mining regions. Electricity prices begin rising in areas with significant mining concentrations. Mining margins compress but remain profitable at current Bitcoin prices. Stage 2. Infrastructure displacement. Utilities prioritize higher-paying AI customers over volatile mining demand. Mining facilities convert operations to AI data centers or shut down entirely. Network hash rate begins declining as unprofitable miners exit. Bitcoin mining becomes concentrated in fewer geographic regions. Stage 3. Security degradation. Declining hash rate reduces network security and increases 51% attack possibilities. Transaction confirmation times increase and fees spike during congestion. Market confidence in Bitcoin's technical infrastructure begins eroding. Price volatility increases as technical concerns amplify selling pressure. Stage 4. Network death spiral. Low Bitcoin prices make mining unprofitable, even with cheap electricity. Massive hash rate collapse leaves network vulnerable to coordinated attacks. Transaction processing becomes unreliable and expensive. Bitcoin loses utility as digital money and store of value. The evidence for Stage 2 is already overwhelming for anyone tracking electricity market developments and mining company financial reports. Bitcoin mining now costs between $60,000 and $90,000 per coin, depending on electricity rates. But AI data centers can profitably pay electricity costs that would make Bitcoin mining impossible even at $200,000 per coin. Texas provides the clearest example of how AI displacement destroys Bitcoin mining economics. The state hosts approximately 25% of global Bitcoin mining capacity, but AI data centers are now offering electricity contracts 400–500% above traditional mining rates. CleanSpark CEO Zach Schultz admitted that cash flows and profitability for a pivot to AI data center services is really the most appealing for shareholders. When the largest mining companies publicly abandon Bitcoin for AI, that reveals the mathematical reality. Bitcoin mining cannot compete with artificial intelligence for electricity access. MEXC analysis shows that access to reliable low-cost electricity has become a defining competitive advantage for firms operating at the intersection of digital assets and artificial intelligence. But AI always wins that competition because it generates more revenue per kilowatt hour. The regional concentration of this displacement amplifies the systemic risk for Bitcoin's network security. Northern Virginia, Texas, and other major mining centers are simultaneously experiencing explosive AI data center growth and electricity grid strain. When these regions prioritize AI infrastructure over Bitcoin mining, the network loses hash rate in concentrated geographic clusters rather than gradual global adjustment. China's experience provides historical precedent for how rapid hash rate concentration changes create systemic vulnerabilities for Bitcoin. When China banned mining in 2021, global hash rate dropped 50% in 3 months, causing transaction congestion and fee spikes that made Bitcoin temporarily unusable for normal economic activity. AI displacement creates similar hash rate loss, but without the possibility of miners relocating to jurisdictions with cheaper electricity. The electricity grid implications also create cascading effects that compound Bitcoin's disadvantage relative to AI. Grid operators in Texas, PJM covering 13 states, and California are implementing demand response programs that pay large electricity users to reduce consumption during peak periods. AI data centers can participate in these programs and earn additional revenue, but Bitcoin mining cannot reduce operations intermittently without losing mining rewards. Mining hardware economics face additional pressure from AI competition for the same semiconductor manufacturing capacity that produces Bitcoin mining chips. NVIDIA, Broadcom, and other chip manufacturers prioritize AI processors over mining hardware because artificial intelligence applications generate higher profit margins. This supply constraint increases mining hardware costs precisely when electricity access becomes more expensive and competitive. Energy storage requirements also favor AI infrastructure over Bitcoin mining in utility planning decisions. AI data centers can integrate battery storage and demand management systems that provide grid stabilization services, making them attractive partners for renewable energy projects. Bitcoin mining offers limited grid integration benefits while creating volatile electricity demand that complicates renewable energy planning. The global nature of this competition means Bitcoin mining cannot simply relocate to cheaper electricity markets because AI data center expansion is international. Europe, Asia, and even developing economies are prioritizing artificial intelligence infrastructure over cryptocurrency mining as economic development strategy. Paraguay, which hosts significant Bitcoin mining capacity, is already planning AI data center incentives that could displace mining operations. Investment capital allocation reveals the fundamental economic forces driving this transition. Venture capital, private equity, and institutional investors are pouring hundreds of billions into AI infrastructure while reducing cryptocurrency mining investments. When capital markets signal that AI generates superior returns compared to Bitcoin mining, the energy competition outcome becomes predetermined. The technical implications for Bitcoin's network security create systemic risks that extend far beyond individual mining company profitability. Bitcoin's security model assumes that rational economic actors will continue mining as long as rewards exceed costs. But AI competition changes the fundamental economics by creating alternative uses for mining infrastructure that generate higher returns. Network difficulty adjustments cannot solve the AI displacement problem because difficulty reduction doesn't address the underlying electricity access constraint. Even if mining difficulty drops 50% to improve profitability for remaining miners, those miners still cannot compete with AI data centers for grid access and long-term electricity contracts. The timeline for this energy death spiral is accelerating faster than most Bitcoin investors realize. ICF Consulting projects 25% increase in U.S. electricity demand by 2030 primarily from AI and data centers, while cryptocurrency mining growth will be constrained by grid access limitations. When electricity demand growth comes primarily from AI rather than mining, Bitcoin's network security becomes increasingly vulnerable. to displacement. Looking ahead to the most likely triggers for Stage 3 security degradation, several scenarios could initiate rapid hash rate decline and network instability. A major mining company bankruptcy could trigger domino effects among leveraged miners who cannot afford higher electricity costs. Regional grid operators could implement mining restrictions to prioritize AI customer demand during electricity supply constraints. Regulatory pressure could accelerate mining displacement as governments prioritize AI economic development over cryptocurrency mining. The proposed Clean Cloud Act of 2025 includes emission standards and reporting requirements that favor AI data centers over mining operations, creating additional regulatory disadvantage for Bitcoin mining. The most dangerous scenario involves multiple simultaneous triggers: Bitcoin price decline below mining break-even costs, electricity price spikes from AI competition, and regulatory restrictions on mining operations. When mining becomes unprofitable through multiple channels simultaneously, hash rate collapse accelerates beyond network capacity to maintain security and transaction processing reliability. Central bank digital currency adoption could also reduce Bitcoin demand precisely when mining economics face maximum pressure from AI competition. If governments successfully deploy CBDCs that provide digital money functionality without energy consumption concerns, Bitcoin loses its primary use case while maintaining its energy consumption disadvantages. So here's my question for you. When AI data centers systematically displace Bitcoin mining through superior electricity economics, when network hash rate collapse creates security vulnerabilities, when transaction processing becomes expensive and unreliable, when the fundamental technology infrastructure that supports Bitcoin is value proposition deteriorates, do you want to be holding Bitcoin through this energy death spiral, or do you want to recognize that some technological transitions create existential threats rather than temporary setbacks? The Bitcoin energy death spiral isn't coming, it's already started. CleanSpark and other major miners are abandoning Bitcoin for AI because the economics have become impossible to ignore. The question isn't whether artificial intelligence will displace Bitcoin mining, but how quickly that displacement occurs and whether Bitcoin's network can survive the hash rate collapse that follows. This is not investment advice. This analysis is based on publicly available electricity market data and mining company financial reports. Energy consumption trends and cryptocurrency mining economics involve complex technical factors that may not develop as projected.